So hello, this is Pete Pigeon. I am the Chief Operating Officer at Hobbs Group Advisors. Today's video is on required minimum distributions, RMDs. We love acronyms in this business. So what is an RMD? An RMD is an amount that has to be distributed out of a retirement account, which could be an IRA or a qualified retirement account, when someone, beginning the year in which someone turns 72 years old and every year thereafter. The IRS says that you did not pay tax on any of this money that went into this IRA. Therefore, you have to start drawing this money out. Keep in mind that these are retirement accounts. Therefore, they should be used to generate income in retirement. So the IRS says, if you're not going to take money out, we're going to force you to do it. So today's video is really about planning opportunities and different options that you have for taking these distributions out. We tend to think that, that with some advanced planning, with some thought, there's actually some interesting ways that you can use these that may be tax advantageous. So with that being said, I'm going to go into my slides and just talk about a few of these options. This could be something that you could do for this year if you've already satisfied your distribution. This also could be something that you could plan to do next year or future years if you haven't started taking RMDs, something to think about when you do, that sort of thing. So that being said, the number one thing that most people do, which probably the easiest thing to do, is just take the money out and stick it into your bank account or stick it into a brokerage account. Our recommendation is to withhold tax when you draw money out of your IRA so that you aren't stuck with a larger tax bill when you file your tax return, right? Because when you do draw money out of an IRA, it's a very easy process to have money sent to the federal government, the IRS, and also your state taxing authority. So take the money out, stick it into your bank account, or take the money out, put it into a brokerage account to reinvest it. That's also something you can do. In both cases, you're going to owe tax on that distribution. So this is probably what's done more often than not. That being said, there's some other ways that we can look at this. So the number one option that we talk to our clients about, and we have quite a few clients doing this, is to send your IRA distribution to a qualified charity. That is called a QCD, qualified charitable distribution. Okay, so some rules around this and lots of reasons why you should consider this, but the rules state that this has to be sent directly from your investment account, your IRA account, to the charity, right? You can't take the money out, put it in your bank account, and then stroke a check with the charity. That doesn't work. It has to be a direct payment. We can facilitate that a couple different ways for our client accounts at Hobbs Group Advisors. One of which is we can have a check sent to the charity as a one-time distribution. We can also have checks, check writing privileges on your IRA account so that you can write the checks to your charity, for example, to the church. You can write the checks weekly, monthly, whatever the frequency is that you used to do, and do that directly from your IRA. And we make sure we have the proper amount of cash available in the account. So why should you do this? Okay. The main reason you should do this is tax savings. Okay. When you take this money and send it directly to a charity, it is no longer taxable. As I mentioned in option one, you take the money out, you put it in your bank account, put it in your brokerage account, it is taxable. This option, you take it and you send it to a charity, not taxable, doesn't show up on your tax return, basically is a wash. So why should you consider doing this? Because of course, giving money to charity is great, but why should you, give money to charity in this case? The easiest low-hanging fruit here is if you're already giving money to charity, right? If you give money to your church, if you give money on an annual basis to 501c3 nonprofit organizations, this makes tons of sense. To understand why it makes tons of sense is to talk about how itemized deductions work on your tax return. So you have to have a little bit of an understanding of how the tax returns work. So with that, I'm going to share another document, which happens to be our key financial data document that we produced earlier this year. Has a picture of me on it. And the idea behind this is that when your tax return is organized, right, you have your income, which includes a bunch of different things, and then you have deductions from your income, which can be a reduction of your overall income. The IRS says that you can either get a standard deduction, which means there's an amount that everybody gets, regardless of what they've done from a deduction standpoint, and then there is the itemized deduction. So, and some of these rules changed in 2017 during the Trump, what we call the Trump tax cuts. So, and what happened during this reform is that the standard deduction was increased, and also there was a cap on how much you can take for income tax, property tax as an itemized deduction. So what has happened over the last probably 5 years is that fewer and fewer people, especially retirees, are itemizing their tax return. So the chances are, if you're giving money to charity right now and you're retired, there's a high probability that you are not getting any credit for your charitable deduction if you are just giving that money out of your checking account. That's not to say that it's the case for everyone, but the idea behind this charitable distribution from your IRA is that we know you can get credit for it if we do it this way. We know we have to take this money out. So the idea is that if you, so just going back to say itemized deductions, right? We get the standard deduction for those aged for a married filing joint tax return. As I point out here, the standard deduction is $25,900. Also, on a per person basis, if you're over the age of 65, you get an additional deduction added, so $1,400 per person. So in that case, we've added $2,800 to that. So we're talking about over $28,000 of standard deductions that are given to each joint tax return that's filed, regardless of what your itemized deductions are. So then we take into account, well, what can you get credit for with itemized deductions? Well, the number one itemized deduction number is mortgage interest. Okay. So, and many of our clients who are retired do not have mortgages. So if you have a large mortgage, then you may have a large amount of mortgage interest. But the other thing that's happened over the last probably 2 to 3 years is that interest rates were significantly lower. So, for example, if you refinanced and you're at a 3% mortgage, which was pretty common, 2 years ago, not anymore, then the amount of interest you're paying on your mortgage may not be that much. So we have mortgage interest, we have taxes paid, but there's a cap on that of $10,000. There are medical expenses, but you have to exceed a very large threshold to take your medical expenses. And then there are cash and non-cash gifts to charity. Those 4 things make up your itemized deductions. Many times, what you get when you add all that stuff up for many of our retired clients does not exceed $28,000. So the idea here is this: let's take the standard deduction of $28,000 that you get for free, and then let's take your charitable contribution and let's do that out of your IRA. It will save you tax in many cases, which is why we recommend this strategy to our clients, especially if you're already doing charitable contributions. Okay. So this is a strategy that does take a little bit of work, does take a little bit of planning, but makes a ton of sense for most of our clients. And many of them are currently taking advantage of that. So what's another option that we can look at? And I'm going to go back to my PowerPoint here. So give me one moment, I'll pull that up. So what's another option that we can use? Another option would be putting some of this RMD money into a 529 college savings account. If you're incorporating some form of gifting to children or grandchildren. The idea of funding a 529 account can help you a little bit from a tax standpoint on your state tax. Does not help you at all on your federal tax. But once again, I think it's a fantastic use of the money, right? The gift of education can be something that can increase earnings potential for your heirs over time, over their lifetime, which has been proven. And so this is something that we talk to clients about, and some combination sometimes of, it's not that you have to do either one of these. You could do a little bit of each. For that example, if you have a very large RMD, some of our clients use it to fund 529s, use it to fund charitable, and then take an amount and put it in their pocket, because you could use it for whatever you'd like to use it for. But in this case, the college funding can help a little bit with the state income tax if you put money into a South Carolina 529. Each state has a little different rule on 529 contributions and whether there's a tax deduction associated with it on your state income tax. So this is specific to South Carolina. Fourth option, which is not a very common option, is to basically take the funds take the money from the RMD, pay tax on it, and then purchase life insurance for your heirs. And this would make sense if a couple reasons. One, there's no need for these funds in your lifetime or your spouse's lifetime. And secondly, if you have a desire to leave an inheritance for your heirs, obviously. So if those things line up, and it's not always easy to figure both those things out, for our clients right away. But if those things line up, the idea of using life insurance can be a more efficient way to leave those assets for your heirs than leaving them in an IRA. And the reason for that is that in 2019, some of the rules changed. At the end of 2019, some of the rules changed for inherited IRAs. The old rules said that your heirs could inherit those, take out a small distribution like we're talking about today, and basically stretch the IRA out as their retirement. That rule has changed. Now, once an IRA is left to an heir, and there's some caveats and some rules to that, but if it's left to children, for example, there is a 10-year rule, which means they have to draw this money out over 10 years. And they have to take out the required minimum distributions. If you had started your distributions, they've got to take out distributions over that 10-year period, and then they got to get all the money out, which is going to create, in some cases, a huge tax liability for them at some point. So the idea of life insurance is that we can circumvent some of that by using some of these funds to buy life insurance. It's, there's still the process of applying for life insurance. There's the process of determining if that life insurance is actually affordable, if your premiums are actually reasonable. So a lot of things have to line up for this to work, but it is a concept that can work, and we've seen work for some of our clients. So that is, I think that wraps up my ideas on RMDs. Our clients are going to be hearing from us on these strategies. Probably already have heard from us on these, as well as making sure that these get done. This is something that is part of the service that we provide at Hobbs Group Advisors. We do tax planning. It's a big part of our value proposition. So if you have any questions on this, please reach out to us. This will be posted on our website as well. And we look forward to having a conversation with you.